This is Lunch Money.
Susan from Canberra on the line. Susan, I believe you've got a question about the uranium market.
I do. Thanks for taking the call, and hello to you and Roger.
Hello.
I was just wondering what Roger's opinion. I don't have any shares in the uranium market at all. I doubt that Australia will be using it in the near future, but I'm also aware that we have quite a large deposit or holding of it for world use. Whether he knows anything about it, the only one I really know about is palladium, but just an overall view, please.
Sure. Look, the real difficulty is that you don't know, or it's very difficult to know when or how this particular resource is going to be utilised. Look, we've got some fair ideas about what they're going to do. And China obviously is a big source of demand for this particular commodity. But whether that happens at a price that makes it profitable for the companies involved to actually make a decent return on their equity or not remains to be seen. Whenever you've got an industrial company, I'm happy, guys. If you want me to switch to another camera, happy to do that. So if ever you're looking at businesses that are selling commodities, you've got to remember there's a cost associated with extracting it out of the ground. There's then another timing issue, so there's a present value cost associated with that, and then you don't know what price you're going to get for selling that particular commodity. It's fraught with difficulty in terms of valuing. I can value palladium, I can value ERA. That's not hard to do, but I don't ascribe a lot of confidence to those valuations simply because the price for the commodity changes so much. There are some easier places to make money in the market, and I'd rather pick up the dollar that I see in the street than try and have to scale a 50-foot fence to make $10.
Good stuff. Thanks, Roger. Roger Montgomery here answering your questions. And we've also got Carol on the line from Melbourne now. Carol, Worley Parsons is the subject of your question, I believe.
Yes, that's right. Thanks for taking the call.
Thanks, Carol.
My question, I've held Worley Parsons for long term. I'm a long-term holder. I'm a retiree. Do I hold the stock? I have a cost of $30 on it, and it's trading today about $21.97. Can you advise me?
Oh, absolutely. Look, this is one of my very few A1 businesses. This really is a top quality company, and there's absolutely no doubt about that. The intrinsic value of this particular company is going up as well, although I have to say to you that since 2007 the intrinsic value hasn't changed that much. The expectations at the moment are that the expectations are that the earnings for this company are going to rise reasonably, and that means that the intrinsic value, which at the moment is about $16.10, my apologies, $20.78 at the moment for 2011, and $25 for 2012. So that's the intrinsic value I've got. Both of those, the 2012 valuation is higher than the present price, so that's a positive. But you've just got to remember that the prospects for this particular business are indirectly related to directly related to resource demand and indirectly related to the quality of growth out of China. There are some very smart people globally, people like Jim Chanos, who have some doubts about the smooth transition of growth in China, and quite specifically, they're worried about a property bubble bursting.
Roger, thank you so much. We've even got another call on the line, so we'll just whip through them while they're coming through. It's Peter from Richmond, Victoria, with a question. Hi, Peter.
Hi. Hi, Roger. I'd like to impart on some of your knowledge in regards to the company Seek.
Sure.
Yeah, they've obviously taken a bit of a slump past day or so, but just maybe if you know their intrinsic value for 3 years ahead.
Look, it's not a hard one for me. It's a fantastic business. See all these online lists. Online lists are great businesses, and the best online businesses are basically an aggregator of just data lists that you search through. So lists of internet results, lists of cars, lists of houses, lists of jobs. They're all lists, and they're great businesses to have. This is an A2, not quite an A1. It's an A2, and I hear your comment about the business slumping the last couple of days. Unfortunately, it hasn't slumped to anywhere near close enough for me to say that it's cheap. That doesn't mean it won't go up, of course. I'm not predicting the share price. The only time since 2005 it's actually been cheaper than its intrinsic value was during the global financial crisis. It's now trading at a price well above its intrinsic value, and I've got a value of $4.70 and going to $5.98. So $4.70 to $5.98 based on its economic performance. Now, the price today
$7.20 I'm seeing
is
on my
$7.20,
screen.
so it is expensive. One, I'm not surprised that it's dropped today. Mind you, I wouldn't be surprised if it goes up either. The market often ignores my valuations. It doesn't really care about those at all. If I want to buy a good A1 or A2 business and buy it cheaper than its intrinsic value, then for SEEK, I've got to wait till it falls below those levels.
And obviously we're talking a lot about the jobs market at the moment. SEEK's involved in that space, but again, do those kind of, I know you're dealing with fundamentals, but you're looking at those bigger picture, the jobs market, how are you kind of feeding that into your view on the stocks?
Look, what I do is I say, OK, well, that ultimately is going to have an impact on earnings, and earnings are going to have an impact on return on equity. So I'll be conservative about my estimates for the return on equity of the company, and then I factor those into the valuation, and that valuation then is what I've just described. So ultimately, the valuation is reflective of what I think a conservative estimate of the future return on equity is going to be. Look, I've written an entire chapter on this stuff. I mean, it's going to go over most people's heads, but I've put a book out and I talk about this in quite some detail. It's not that hard to do.
Roger Montgomery, we're continually talking about the oil price.
Sure.
Is there
I
any
heard you say earlier oil slipped. And I
Slipped.
thought that was appropriate. Yeah.
Very nice. I didn't even know how clever that was. Have you got any picks in that sector at the moment?
Not at the moment. Nothing that's coming out as a roaring buy. But let me say this: if you have a view on oil, it's often prudent to think about exposure to the commodity directly. I've purchased oil futures on many occasions. I'm a long-term oil bull. I think ultimately we'll run out of very cheap oil, but that doesn't mean that in the interim, doesn't mean it goes up in a straight line. In the interim, if there's any doubt about economic growth globally, then you're going to see oil reflect that and the price will drop. But let me say this, if you think the price of oil is going to go up, some people are beholden to buying oil stocks, but remember, when you buy a stock, you've got stock market risk, you've got discovery risk or exploration risk, you've got execution risk, you've got board risk. There's a whole bunch of commodities that could go up, and yet the companies that produce them could go down or go broke, particularly if they don't find anything. So you can speculate about these things because it's very difficult to invest in them unless you've got a very long-term view and very deep pockets. And so I tend to focus on the commodity itself rather than the stocks that are producing that commodity.
Do you see oil as a barometer? People talk about it as being a barometer for global growth, and this week people have obviously been adjusting expectations with the numbers out of China and the United States. But then again, so's copper, and copper's kind of been roaring lately. Where do you see the signs?
Individual commodities will have their own supply-demand equilibrium points, and they'll be at different price levels. And so you've got short-term. You mentioned in your introduction to the piece on oil that the price dropped based on surprising supply increases. Well, that's a very short-term issue.
Today.
Yeah, that's today. Tomorrow it'll be something else. And this is what I mentioned earlier: the cause and effect. And so it's much easier to take a longer term view. It's almost impossible. You hear people like Jim Rogers, who's one of the most profitable commodity traders in the world. He'll say he has no idea about where the price is going to go tomorrow or the next day, but he has a very long-term view. And if you have a long-term perspective, it often means that you'll position yourself appropriately, and by that I mean you'll allocate an appropriate amount of capital, because you'll say, well, OK, look, for me, I think oil could be $200 a barrel in 5 years' time, but I don't know when it's going to get there, and I don't know what's going to happen in the interim. So I have to say to myself, well, I'm quite happy to have a position in oil where if the price halved, it's not going to be meaningful for me in terms of an interim capital loss. And then you start to position appropriately. But again, you have to be fairly convinced of your view, and you've got, I don't want to convince other people of my view because they might lose money and it'll be my fault. So look, that's just for me.